Most people think the model is nuts. It doesn't work. It's spray and pray. It's all these things. My big takeaway of 10 years of venture capital is like, there is no right way. And I get very exhausted by people just saying it's one way. Like, I don't think this is the way for everyone. I think this work is my life's work. And I have spent the last 10 years figuring out like how this system actually works. So it's the right model for me. It might not be the right model for you.
Hey everyone, welcome back to the Ignite podcast. Today, we're thrilled to have Jenny Fielding on the program. She's the co-founder and managing partner of Everywhere Ventures. She's one of the most respected early stage investors in the game with 300 plus investments under her belt. Wow, that's incredible, including unicorns like Chain Analysis and Alloy. Before launching Everywhere, she spent 7 years as the managing director at Techstars NYC. Amazing. Where she helped build a portfolio now worth over $10 billion. She's also a two-time founder, adjunct professor at Columbia and Cornell. What haven't you done? And recently an author of Venture Everywhere. Let's dive into her journey. Thanks for coming on, Jenny.
Thanks so much for having me. I'm very excited to be here.
Well, why don't we start at the beginning? I'd love to know like how you got into this crazy world of venture capital. What did you want to do when you grew up? And what were some of the turning points into tech?
Yeah, well, I'm both an accidental entrepreneur and an accidental venture capitalist. When I was young, I wasn't really sure what I wanted to do, but the model in my family was kind of work for yourself. So I didn't have any tech entrepreneurs in my family, but I had lots of small business owners and people that were, kind of building the life that they wanted to see and working really hard, but maybe on their terms. So that was the model. Interestingly, I took a very different early career, which is I went to law school. So I worked in law and finance, big companies, JP Morgan. One day I ended up seeing a pain point in the world and wanting to solve it, not really thinking of it as a startup, but just thinking of it as like something that needed to be fixed. And nights and weekends started hacking on it and ended up starting a startup in my living room, like many other entrepreneurs, but definitely was not on that journey. And then, I ended up bootstrapping that first business while I was working at JP Morgan. Finally left. I've just been building startups and investing in them for the last 15 years.
Wow, what a founder story. So you were literally moonlighting as a founder, bootstrapping this thing on the side, evenings and weekends, until you kind of got it going enough where you're like, okay, there's some legs here. What was that idea and how did you come up with it?
Yeah, well, I had a boyfriend in Germany and I was making lots of calls on my mobile phone. Now, back in 2007, if you can recall those ancient times, it was crazy expensive to call on your mobile to Europe. So, I mean, we're talking like, $10 a minute or something. Wow. And my phone bill was totally crazy. And I just thought, wow, there's got to be a better way. At the same time, I was working at JP Morgan and I saw there were many, many people there who were not from the United States and they were calling friends and family and they were using these calling cards. And these were like people who were working at JP Morgan. They were making, a bunch of money. And I thought, okay, well, that's interesting. So you had kind of an interesting mix of really what a market was. And ended up starting that company, again, in my living room with some co-founders, just thinking of it as like, hey, this needs to exist in the world, not let's go start a startup.
Yeah, amazing. And that's the best founder story. What do you have to will into existence here? What should exist that there's a gap in the universe, so to speak? And you just have to.
And it's interesting because that was how I started Everywhere as well. I was working full time at Techstars and kind of saw an interesting gap. Like I love the Accelerator model and what Techstars was doing, but I was noticing my companies, some of them were quite good, and it was just hard to get pre-seed capital together. It was hard to get kind of people that had been there before who had some institutional knowledge around the table. And so I thought, well, maybe I could put together something that was kind of a hybrid of what I saw out there. So I looked at different models. I looked at what angel groups do really well, which is really around community and crowdsourced deals. What they don't do really well is like maybe the governance and the time to make decisions. I looked at what funds did, which is obviously, quick decisions, governance, process. But, a one-to-many model doesn't really work, right? So you have one GP and they can only sit on so many boards. And so I thought, well, hey, this is interesting. What if we can create a many-to-many model? So we'd have founders and operators as our LPs, the people that give us money. We would build this community of founders, and then we'd be able to support a really large portfolio because we had this kind of community. So it wasn't Jenny supporting 300 companies. It was a community really supporting those companies.
Yeah, amazing. I came up with the same thesis independently, which is Team Ignite, but I kind of came at it because we started as a syndicate. I was like, well, what do syndicates do? My wife says she came up with the name, but I'm like, I don't know about that. But we have an argument about that. But we were having sushi, and I was like, I think I'm gonna start a syndicate. I don't know what to call it. And she's like, okay, what do syndicates do? I'm like, well, they're like a team of people that grow startups and invest in them. And so that's how we came up with the name. And that has been our ethos since. So it's really incredible that we both have a similar thesis.
Yeah, well, give your wife credit for that, please. I think that's a good plan. But yeah, when we did this, we came up with the idea in 2017, 2018. And quite frankly, at that time, there was just a lot less, kind of this model. I think now we're seeing a lot of funds that do it. And quite frankly, that delights us, right? Because we think that founders and operators are a really good support mechanism for early stage founders.
Yeah, and it's really kind of this whole trend of angel investing that Angel started, 10 or 15 years ago. And, that was really enabled by probably the cloud revolution before that, right? So now it just, instead of spending 5 million to get your website up, it took almost no money. I've been thinking about this a lot, and it seems that you've given it some thought too. And I think we're both beneficiaries of this movement in VC for smaller LPs to have bigger impacts and smaller GPs, and to have these community impacts. How do you think AI is do you think AI is just like going to accelerate this and enable us GPs to do even more for more startups?
Yeah, I mean, I think the fundamental problem in venture is that there's a small number of you and I writing checks, and there's a huge number of founders. And whatever mechanism you build, whatever mousetrap, whatever funnel you build, the truth is you're still outnumbered by a huge amount. So I can't really take cold inbound because, I only have certain, a number of hours on my day. And I'm getting now about 400 emails a week from founders. So How do I make that work? That is inherently unfair. And I hate that about this industry, right? There just isn't a good system. So what I like about, automation and some of the tools that we might see being built is kind of the democratization of venture capital in many ways. So I feel like, a wave that we've recently seen is the everywhere wave, which is like, wave one was you had to be in Silicon Valley and you had to be within 25 miles of Sand Hill Road because that's as far as the GP would drive. Wave two was, kind of accelerated by COVID, but maybe started a little bit before that as we saw, innovation everywhere, capital, starting to kind of go into other ecosystems. And I've been, the beneficiary of being part of some different ecosystems that I saw go from practically zero to, very accelerated. So I live in New York City. When I started my company, it was a terrible place to run a startup. And now it's the second largest tech ecosystem. I lived in London, kind of at the beginning of that scene really starting and all the momentum in London. So it's been really fun to see that. And I think AI is the next accelerant of capital really being dispersed and opportunity just coming to startups using this technology. So I'm not sure what it is yet. I don't think any of us know. I mean, right now it's tools that you and I can use, but I think we're going to see, some real interesting innovations in the next couple of years that are going to really help the matching, the sorting, like all that kind of stuff, which is going to benefit folks like you and I.
Yeah, I agree. And I'm starting to layer in AI into all my processes, but it still can't make my decisions for me. It could maybe prioritize some of the deal flow. I get tons of inbound. And I have this, I use this app called Techstars, which is a Chrome extension with these 2-letter shortcuts. And I have about 100 shortcuts. And so I don't even think about what I need to say. I just think about what shortcut is it. So like a cold inbound gets the founder form shortcut, which is FF. And it basically just says, hey, thanks for getting in touch. Would love to take a look, fill out this form. And then it goes into this Airtable. And then we process it with some 4.0 calls and stuff like that to score it. And it does a pretty good job. It doesn't make a decision, but it does help prioritize. I literally have hundreds and hundreds of these cold inbound Airtable form fill outs. And so I'll just, every once in a while, just dip my toe in the water and see if it's warm. And inevitably there's something in there. There's probably out of like the hundreds, there's, maybe a handful worth meeting. It still doesn't have the decision-making capability, right?
I think this is going to start to change.
Yeah.
So I think what you've described is kind of machine learning and some automations that you've built in. And I think we're going to, jump quite quickly. And we're seeing some interesting, consumer applications. We're obviously seeing it, with coding. And, I've been, as a non-technical person, kind of experimenting with some really fun things. Actually, I'm creating like a little Jenny bot for my website. And and the fact that like I can be part of that creation as opposed to I need to call someone or hire someone to do that, I think is really revolutionary. So I think it's not just like, I think what we need to do is take our hat off of like this is how it's done, and AI is going to help us do that faster, and just start thinking like really crazy. Like the Jenny bot is going to be able to be my persona in the world. And, you know, you and I can go play tennis.
Kind of in a way, like what's the ultimate end state here of capitalism is like AI and robotics and, you know, information technology has just automated everything. And like humans are just like doing just podcasts, I guess, and playing tennis. And I've been thinking about this a lot. Yeah.
The current administration thinks that we're going back to the factories.
Oh, yeah. Everybody's going to go back to factories and build stuff. It's going to be great.
We're going
back.
To
build iPhones and stuff.
We'll see how that goes. But yeah, I think we have to like literally just think about, you know, the promise of like what avatars were and being able to have, you know, multiple literally Jenny agents out there at different events doing different things, interacting with different people. So yeah, it's an interesting future and it's kind of fun to fantasize about, but I do think it's coming. So we'll see.
It is coming in our life, like in the next decade, it feels
For
like
sure.
we're going to be reckoning with. And I think what'll happen first is it will be that thing that you said, which is an acceleration of what's the status quo. But eventually there's this complete automation and sea change, this shift in the paradigm of how everything's done, like pre-electricity, post-electricity. You know, it's just all of a sudden it's, wow, we're just electrified everything. We've cognified everything with AI and the world just is different. And maybe we're all just solo entrepreneurs creating things with AI's help and kind of sharing it with each other. Yeah, it's a weird.
I'm not kidding about the Jenny bot. Like I'm training it. Like we're training it right now, and it's really good. It's starting to get like my tone and kind of my snarkiness and all these things. But like all the knowledge that I have after 15 years of being an entrepreneur and a venture capitalist, I'm actually seeing come out. You know, as I put these prompts in, I'm like, oh my gosh, that's the exact thing that I would have said. And yeah, I mean,
and now you'll be able to take this podcast and plug it into the training and all the other videos of you.
It's scraping from all content, LinkedIn, Twitter, like all my blog posts, all the podcasts, all the media I've done. And then you further train it. So I don't know. I mean, it's wild. So we'll see.
What platform is this that you're using for that?
Coming soon. You'll learn more.
Okay. All right. Not announceable right now. Okay, great. So let's talk about kind of venture capital mechanics, like the size of your fund, what fund number you're on, how many investments you're making, like stage sector, geo, all that stuff. Kind of standard VC questions.
We do a crazy thing, which most people think is weird, but we have a very large portfolio. And so each of our funds has about 80 investments, so quite large. And we are on our third fund. So we've been, you know, doing this for about 6-7 years, since 2018. Most people think the model is nuts. It doesn't work. It's spray and pray. It's all these things. But the truth is we returned our 2018 fund, and that puts us, you know, way above all the people.
Yeah,
that
you're in the
say
top probably 5% of funds.
I mean, my big takeaway of 10 years of venture capital is like, there is no right way. And I get very exhausted by people just saying it's one way. Like, I don't think this is the way for everyone. I think this work is my life's work. And I have spent the last 10 years figuring out like how this system actually works. So it's the right model for me. It might not be the right model for you. Right. So that's my little...
I totally agree. And I came up with this independently. We're so aligned on a lot of how we think about venture. The way I approached it was like an asset manager because I, you know, CFA, Wall Street guy. And so I looked at it like, okay, if I was a money manager placing bets in this asset class, like what is the optimal asset allocation strategy? Like mathematically, statistically, what would be the optimal amount of startups? And if you run Monte Carlo simulations on early stage, it's different if you're A and B and C and stuff. But if you're doing pre-seed and seed stuff like we do, it's about 100, you know, 80 to 100, maybe 150, somewhere in that range of startups to hit the best outcome possible statistically.
And it's funny that you say that because we just went through the exercise of building the Monte Carlo and using it. And whew, I mean, that's intense, but it's really, really fun when you have the model and you can start playing with the input. So, I mean, I just laugh when I literally am sitting in front of, you know, a limited partner, the folks that give us money, and they're like, it doesn't work. And I'm like, but I've outperformed your managers of a model that you said does work. And they just look at me and says it doesn't work. So it's just a very weird...
Well, yeah. What do you think that dynamic is? I've had a lot of these LP conversations. Yeah.
I'll tell you what it is. I know exactly what it is. So their stakeholders, they have to say like, our managers use their 8-ball, their secret sauce, their whatever. And if they say like, actually, Jenny is running, something that's way more simulated where she needs to have enough shots on goal and like she'll hit a couple unicorns as we have because we have enough shots on goal, kind of makes them look bad or lazy. And so they'd rather go with the narrative of venture is a craft and you have to, that whole thing. So there are all these like narratives in venture that people kind of live up to. So it's venture is a craft and you need to study the craft and you need to do all those things. And I just think that that's, not exactly true. I have pattern recognition of, 7.5 years at Techstars, thousands of applications, thousands of interviews. And like, for me, that's my secret sauce. So it's having enough shots on goal and it's knowing what good looks like based on 10 years of pattern recognition. And people don't seem to like that.
You've seen a lot of crap come through, and then you've seen a lot of amazing, shining shooting star breakouts.
Other thing that people don't really understand is there is a difference between pre-seed and seed, right? So the companies that we're backing are really, really early, mostly idea stage, and there's just going to be a huge loss ratio. And so if you're not comfortable with that, like whenever we meet an LP and they're like, what's your loss ratio? And we tell them, and I actually say it's actually not high enough. And they kind of look at me and be like, well, why would you want it to be higher? And I'm like, because it's an opportunity cost. I need these companies to move through the cycle and then start these founders to start new companies and for me to, write those old companies off if they're not working. And they kind of look at me shocked because if you have 20 companies in your portfolio or 25, like a regular seed portfolio, that's a harder pill to swallow. When you have 80, like your loss ratio is just going to be a lot higher and you're going earlier and you have to be okay with that. And so, I never like it when a company doesn't work out, but I can't even tell you how many, now that I've been doing this for so long, companies didn't work out, amazing founders, we backed them again, and those have been some of our highest performers. So, you can't hide from product market fit. It doesn't matter how good your team is. If the market's not ready, or it's just something that the market is not interested in, doesn't matter how, all the other great things, how much money you have, how great the team is. And so you can never hide from that. So why not shut it down and start something else?
I love that. Yeah. And I agree. And some of the best founders are those second and third time founders who come back and you back their ideas over and over again because they're great founders. And one of them is going to break out.
Exactly. And we now have the data around it. I mean, we probably have 5 founders that fund 1 shut down and in fund 2 or 3 are our top performers. So,
I love that. Yeah. And there's a little bit of, it's interesting, venture capital, because, there's this old phrase in finance that you can't beat the market and the past results are not indicative of future results, right? But the opposite seems to be true for venture, whereas the longer you're in it, the better you get at it to a point, I think. There's probably some asymptote where like you get too old and you're making bad decisions or something, but it seems that the longer you're in it, the better you are able to pick them. You have more deal flow because you've backed more founders, you have a bigger network. And there's a little bit of survivorship bias maybe, or survivorship benefit. The longer you're in it, the better you are.
As long as you stay hungry and in the game and don't outsource it to junior people or go play golf. I mean, I think that is what we see a little bit on Sand Hill Road when some of those funds that we thought were institutions are just kind of sailing into the sunset now. It's hard to kill a venture fund, but you kind of see the ones that are quietly
kind of winding down a little bit.
Yeah, winding down a little bit. And oftentimes it was because those partners just maybe lost their hunger a little bit. So I think, it's a hard asset class. It's hard to make money in this and it's hard to be good. So I think you need to, maintain that hunger and that appetite. And I think I just told you or I told you before, I just went through a really bad surgery on my shoulder and I was really out of it for almost a month. And I was reading emails, taking pictures on my couch with the camera off because it's you just
on painkillers.
You just literally cannot miss a great deal. And I'm kind of a startup addict. My co-founder was like, Jenny, you just need to rest. I'm like, I'm on my couch. I have ice all over me, but I have to hear this pitch. I'm so excited. I think once you lose that hunger, I think it does get harder. But
it's interesting too, because, I'm not as far into it as you are, but I'm, 5 years into Team Ignite, 7 years into my investing journey. And sometimes there's days where I don't want to come to work, right? I'd be honest, but every time I do, which is every day pretty much, I'm always glad I did. And so it's like venture capital is almost like going, sometimes it's like a party. You don't want to go to the party. You're kind of like, I don't feel well. Maybe I'll skip the party today, tonight, whatever. When you do, you're like, oh man, I just had that great founder connection, or I just saw this really amazing demo, or you just have great connections. And it's kind of like doing this podcast. Like, I never know how these conversations are going to go. This one's going great. And I learn a lot and connect with people. And it's just a really amazing industry in that way.
But I bet there are some days you're like, oh, the podcast, I need to talk to Jenny.
Well, right. We talked about it right before we started recording, right? So this is so funny because people don't know this, but we tried to record this podcast last week and you weren't feeling well because of your surgery. And so we just kind of stopped the recording and said, hey, let's just postpone it. And then this morning I did this erroneous capital call. And so I have this like fire I'm putting out right before the podcast. And I'm like, maybe I should push the podcast and deal with this fire. I'm like, you know what? No, I'm just going to do it. I'm just going to like power through it. And it's turning out really great.
I'm cheering you up because those types of things happen to all of us. Doesn't matter how experienced, how good. You just have those moments where you're like, oh, how did that happen? And you know what? I think in a way, that's why, especially running small funds, we're so much more aligned with the founder journey than people think, right? Like you and I are building a business and it's not quite as intense as the ups and downs I had running a software company. Right. But, let me tell you, every day I have a portfolio of 300 companies. There's a shitstorm every day. There's something where
some pay to play round, some down round.
Oh my goodness. Yeah. And then every day there's like, some founder of like a company that I literally thought was dead calls me and is like, we're doing a $10 million Series A. And you're just like, oh my gosh.
What?
So the highs and lows within a day are like, it's just a lot.
It's real.
And I think you need to have that resilience. It's actually something I talk about in the book that I wrote. I call it, instead of resilience, I call it elasticity. So you have to have that ability to just respond to what's ever out there and not let it get to you or let you crumble, And I think learning that in my book, I interview these amazing founders who grew up in, far-flung places, many of them war-torn countries or, developing countries. And they just had to learn from an early age how to, cultivate some of these characteristics that are their armor for the world. And in fact, it actually does lead to being good entrepreneurs, maybe in our case, hopefully good managers.
What do you think gave you that resilience, that elasticity that you have? What was it about your background that made you so resilient? Because you clearly are. I mean, you've been doing some pretty hard stuff for the last couple decades.
So I grew up in New York City, I will say, a pretty kind of privileged life in many ways. I think my family, I was an only child. My parents would leave me at a very young age and I had to just like fend for myself in many ways, right? Like I remember at 6 years old, like not having a babysitter and just having to figure stuff out. Yeah, I mean, I think it was just the fierce independence and there just wasn't like, my parents weren't like, we're going to entertain you on the weekends. Like as an only child, I had to figure out my own entertainment, right? And so just being resourceful, I think, in a way makes you resilient, because you just have years and years of these things, like having to do your own laundry at 7 years old and having to, make your own breakfast because like, no one was there to make your breakfast. And again, I was not neglected in any way. I know people are, thinking about that. But yeah, it was just a very different type of upbringing. And there were many very cool, joyful parts of it. But I think that definitely builds a little bit of character.
And how do you think that translates into spotting founders? I mean, you mentioned pattern recognition. Techstars, of course, is a very batch processed, thousands of applications kind of firm. And to a lesser extent, you guys are as well, maybe a little bit more downstream of, of Techstars in some cases. But how do you spot amazing founders?
So I think, that kind of resilience we try to test over the time that we're meeting founders. So we're investing in, usually like 3 deals a month. So everyone says like, oh, you meet a founder and you write a check the next day. The truth is like, we have built this really interesting flywheel where we're getting to know founders over weeks, months, and years. And so it's kind of tracking them and figuring out like, what are some of the ways that they interact in the world that we think contribute to good entrepreneurship. So I'll give you an example. We met a founder, we were, really interested, and there was a lot of kind of discussion about the side letter and pro rata, and it was like going back and forth a lot. And a lot of it was like, we were told to like go talk to his lawyer. And like my co-founder and I, like at some point just looked at each other and we're like, you know what, if this founder can't figure out like how to, have these difficult conversations, negotiate it, not just like outsource it at the early stage, how is he going to be able to run the business, right? Because there's going to be these challenges all the time. So that was something we learned over weeks, as we were getting to know him, as we were kind of understanding the terms. And eventually we were like, you know what, this founder doesn't have what we consider that resilient gene, that can just get stuff done quickly, high cadence, that fast founder. This was like, I don't want to deal with it, outsource, I have other stuff to do. We just didn't think that that was a characteristic that was going to be successful. Try to stress test some of these things by getting to know founders again over time. And sometimes it's just like, you go out to dinner with them and you get to know them, but sometimes it's these kind of subtle breadcrumbs that they drop as, you're going through a process with them or as you're, meeting them.
You can tell a lot in the due diligence actually after you make the offer. I'll start due diligence and you can really see how buttoned up they are too. I've passed on rounds where it was just messy. Like you just get in there and like things are misstated or things are just messy. It's just not buttoned up. Sometimes you're not sure and you kind of start due diligence and you start leaning yes as you get deeper and deeper into the company. Those are the best, right? You're kind of like, okay, the more I look at this, the more I like it. Now, before we continue, a quick word about an incredible resource for startup founders. This episode of the Ignite podcast is brought to you by Build, spelled BYLDD. So what is Build? Well, they specialize with early stage startups, especially non-technical founders and teams, helping you build and launch scalable revenue generating software fast and affordably. Most startups can't afford to drop 100K on some big design engineering agency. Freelancers are risky, inconsistent, and full of project management headaches. For 10K in about a month, they can turn your validated idea into a real market-ready product. It's built for scalability. Past clients have been accepted into YC, Y Combinator, very impressive, received backing from Google, and raised multi-million-dollar rounds. And there's an exclusive offer for Ignite listeners. Get a free UI UX design sprint that's 3 to 4 weeks, a deep dive into your product experience, delivered completely free. This is normally a $10,000 plus service. So head to byldd.com, connect with the Ayush team, mention the Ignite podcast. Let's get back to it. Yeah, how do you guys conduct due diligence in so many companies?
Yeah, again, well, the first thing is we use our community of founders and operators. So, people are unfortunately, we're unable to really take a lot of cold kind of off the street inbound. And our deal flow comes from those 500 founders and operators who are eyes and ears on the ground wherever they are. So first filter is that it comes from someone that we trust, someone that has given us money, so very aligned, and someone, we think has a good lens on things. They may not be full-time investors, but they're operators, they're founders themselves. So that's kind of like level one. By the time it gets to us, it's already somewhat interesting. My co-founder and I have certain verticals that we like. So I do a lot in fintech, I do a lot of healthcare. Scott does a little more in consumer. We do, a bunch in future of work. So if it fits within some of the areas, we do climate, logistics, then, next filter is like kind of has to be within that range. And obviously it has to be pre-seed. We get a lot of, we're raising a $5 million pre-seed. Well, that doesn't really fit within our rubric. We consider pre-seed like rounds that are about 500K to 2 million. Anything more is probably just not going to fit our model. So, it's things, the funnel starts getting smaller and smaller. And then because we have this great community, if it's a healthcare company, I can send it out to 50 healthcare founders that very quickly on Slack just give me a quick read on like, hey, is this actually interesting? They can oftentimes they'll say, you should ask them about this. And the best response I get from our LPs is like, hey, I'd like to talk to them. So, one side of the access is like by vertical, we have these experts and we don't have 5 or 10 of them. We have probably, at least 50 in every vertical. And then, the second one is really by geography. So we invest globally, which is also kind of weird and unique. But in every ecosystem, we have, again, 25 to 100 people so that we can cross-reference these people in terms of, character and what, where they are. So we recently did a deal in South Africa. Well, this founder actually knew 5 of our other founders there and a couple of our founder LPs. And so we were able to back channel of, well, what was his reputation and, how did he, interact in the startup? And we got like really interesting data. So yeah, we try to get through, like build systems where we can get through the diligence very efficiently using this community.
Love that. Yeah, same. I'm learning things. I'm taking notes. Thank you for that. We try to do the same here. Sometimes, we do a better job than other times, but aspirational. I want to talk about scaling, because you said something funny, which is like, some of these dwindling, sunsetting venture capital firms are just out on the golf course and letting the junior people run it. How do you think about scaling, or do you want to scale? How big do you want to get? Do you think about building out a team as you guys raise bigger and bigger funds and have more success, or do you kind of take the benchmark route where you're just like, nope, we're all just partners and we're very small and
I
we're
think
always going to
scaling
do
is
this?
is
Yeah.
the death of a venture fund or, any type of investment vehicle. And, actually I saw it firsthand at Techstars, being there many years. When I started, there were 25 full-time people. When I left, there was 300 plus. And the truth is, what, we all realized was that this is not a software company. You're not going to be able to, the rule of 40 doesn't apply. It's a services business, and services businesses, as you know, just really don't scale, right? Because it's all about people. So if you want to scale, you have to add people. So the only way that Everywhere gets bigger is that we add more general partners, which potentially we might down the road. But there's really no way to kind of scale with a small team and do, what you're doing really well. So I don't want to make the mistakes that I've seen be made before. And the truth is, like, I don't know why, maybe I'm trying to figure out why. Like, why are people obsessed with scaling? Like, why can't we just be happy with what we have? Like, I am thrilled that we run small funds. I love everything about it. And
Well, I
maybe
got to have a bigger yacht than Jeff Bezos. I mean,
it's just not really of interest to me. So maybe
yeah.
maybe that's it. I mean, maybe folks want to scale because they want more management fees to live on. Like, honestly, that's just not our game. Scott and I put all our money back into the business. So it's a weird thing, this idea of scaling. Again, the way that we would do it is we would add another general partner who would be responsible for, whatever that part of the thesis is. And I think that's a way you can scale, but it's not something we sit around thinking about. We love the work we do. We love the stage we play at. And we think it's totally bogus when billion-dollar funds say they invest at pre-seed, right? Because it's just like not true. Or the pre-seeds are $8 million, or they're just, optionality checks that they just have their scouts right, which is different. So yeah, we just love being at the stage that we're at, and you can't have hundreds of millions of dollars and do that.
So if you could go back and be the managing partner of Techstars, how would you have scaled it to do more investments?
Well, I wouldn't have. So I don't want to get into it too much. But
kept
like,
it very
again,
small.
I got there was, I don't know, like 8 accelerators running, and I would have just said, like, those run great. Let's just keep on doing the work that we do. So, I mean, I think maybe that's the difference. And I think we need to uncouple scaling and ambition. I don't think anyone's ever said I'm not an ambitious person because I don't want to scale a model that I don't think scales. So that's what I would have done if I was in that position. And I feel the same about my venture fund now that I am in that position. I'm just happy to raise, our small $30 million funds every couple of years, do the work that we're doing, and reach more founders. And again, maybe we'll bring on some more partners and change that. But yeah, right now we're pretty psyched.
Love that. Do you think in the future there's a time where you kind of do what Homebrew did and you're like, maybe we won't raise another fund and we'll just run the family office, the Fielding family office?
I think about it all the time. I think why we're lucky. So lucky and unlucky. So lucky in that we have the most amazing LPs. They're founders. We've backed many of them. So, they back us, we back them. So the alignment is incredible. We really respect the businesses that they're building. They offer incredible deal flow, help, all these things. So we love our LP base. They give us no aggravation. They're just incredible. The challenge is that they're individuals. And so when the market is down, when tech is down, it's harder for them to pony up cash to support us, even if they want it, right? So when tech started, really in a free fall a couple of years ago, like those were the people that had backed us. So it's very hard to raise money from the people when their companies are struggling.
Right.
Right now, we're not in market, but right now is a very rough moment for many high net worth individuals who've just seen 10% of their portfolio fall. And so if you're raising right now from, high net worth, like, good luck. That's going to be tough. The nice thing is if you have institutions, they're much less sensitive to these things because they have, their funds are usually raised a long time in advance, and they've got, a long-term plan. Their allocations are less volatile, shall we say. So every time, my point is, every time we go to market with a new fund, we're like starting from scratch, right? It's like, okay, who has money right now? We need more people. And, that's just tough. Whereas if you have institutions, they usually commit for a couple of funds, and it's usually not that tough. But again, we love our LPs. They're incredible people. We wouldn't be here without them. And we just feel really grateful that they're supportive. The calls I get from them are just all like, hey, Jenny, how can I help? So I think that's really unique from what I've heard from other managers.
I love that. I'd love to also dig into a little bit of your pattern recognition over these hundreds and hundreds of companies. What's, especially because you're at Techstars before that, and now everywhere. What is that kind of gut check? What are some easy yeses for you when you kind of see it? You're just like, yep, let's go.
Well, my best companies have not been, they've been easy yes from the founders. They've been hard yeses from the space. Because the best, biggest unicorn companies I've found over a decade, so I've been the first check into five unicorns, have looked so crazy at the moment that it was just kind of hard to understand, but you had to like just suck it up and say, these founders see a future that I don't see, and that's beautiful, and we need to support that. So
Wow.
I think the challenge is like, oftentimes you meet shiny things, they have revenue, the team looks good, whatever, but they're really solving a problem for today. And you worry that where the world's going, that they can be displaced really quickly, that they won't be able to scale, all these things. Whereas when you invest in founders that just have this very clear vision of some, seismic shift that's happening, then those can actually be big companies. So it's hard. You have to check yourself all the time. I mean, obviously you have to have a great feeling about the founder, but I found, you have to really believe in their vision. And the crazier the vision is, I think the more upside there is. That's how it's played out in my portfolio.
That's really interesting. Yeah. And I've heard echoes of this or parallels of this around the community of venture, the non-consensus bet, the category defining visionary future, right?
I mean, I haven't backed a unicorn that was a turnkey SaaS, right? Everything has been just, building a factory of the future, or, a healthcare company that had very complex business model and all these things, or, just like a crazy fintech company that, had a vision of like, how APIs were going to transform a very antiquated industry, or, Chainalysis, which was blockchain analytics, which everyone said like, why do you need analytics in 2015? Because this is a cottage industry. It's tiny. So it's like, that's not going to scale. But they had a vision, not just of the company, but they were like, hey, picture a world when your grandma is using Ethereum. Totally mental there, right? Because my grandma didn't even know what Ethereum was. And like, here we are 10 years later. They're the largest blockchain analytics company. Obviously, crypto is massive. And so you don't have to convince anyone that's a big market anymore. Whereas they got turned down by many, many of the top firms when they tried to raise their seed round because market size.
Yeah. Yeah. And you have to think it's kind of like Wayne Gretzky, like I always skated to where the puck was going to be. In venture capital, you're always investing, where the market's going to be in the future, not where it is today. I love that. Like that.
Yeah. Like we backed last year a company building data centers in space, which like today sounds totally mental, right? Like,
it's wild.
That's wild. Yeah. But we have to think in 10 years where things are going. And it might not go that way, but it really might. And that company could be a really big company. And they're doing great, and they raised a massive round. So.
That's completely wild. It's a big part of why I think for my next fund, I'm going to generalize my thesis a little bit. So I can do these non-consensus off-category kind of bets, right? Category defining bets. And I'm not going to define myself as B2B software anymore, or AI, fintech marketplaces, which I historically have. I want to just define myself as just pre-seed and seed. And then that way I can make these wild data center in orbit bets.
Great.
Because if they work,
they're together, Brian. So really my pattern recognition is like, yeah, you can invest in, tax automation software, and like, yeah, that could be a great business. That is solving a problem today. Like you just have to, there's just a lot of things to think about where that's going. Or you can invest in something that seems like totally mental, and there's different roadblocks there. But you don't have to worry, about competition. You don't have to worry about displacement. You just have to worry about like, will this become a thing? So, maybe a portfolio needs a healthy mix. But if I do look at my 5 unicorns, they were all pretty nuts.
Pretty non-consensus, nutty kind of bets at the time. Yeah, which is amazing. Really good lessons there. So let's talk about teaching and writing. So what sparked your move into teaching at Columbia and Cornell?
So never thought I'd be an adjunct professor or would be teaching anything. Although I think when you work at Techstars and the model is really around, surrounding founders with resources, and part of that resource is content, you do a lot of speaking in many ways, and synthesizing information for people. And so I think that's kind of what teaching is. But yeah, I went to Columbia. When I was there, obviously there was nothing around entrepreneurship. And so I had an opportunity to kind of co-create a class for entrepreneurs, on entrepreneurship for undergrads. So that was super fun. And it's just fun working with undergrads because the way they see the world is really different, and you can really make an impact, right? So I always at the beginning of the semester, all my students are going to work at Goldman Sachs, and by the end they're like, oh, maybe I want to come work for a startup. So that's very rewarding to be able to, have a very small impact on, these brilliant minds. So I kind of love it. And then a couple of years ago, I started teaching at Cornell Tech. So they have a very innovative program. It's a 1-year multidisciplinary program. It's here actually in New York City, so it's not up in Ithaca. It's on Roosevelt Island. Yeah, it's a graduate program, and everyone is building startups in my class. So I co-head the startup studio, which means for a few months they spend time with me actually building startups.
Wow.
They kind of compete for a big competition where they can, win money and all this at the end of the year to pursue their ideas. So it's just been such a joy. Those students come from around the world. There's more than 400 of them in my class, so it's massive. And I think one of the most fun things about it is you get to see what students are interested in, what's on their mind, what are they worried about, what are they excited about. And so you kind of get to see those patterns of where that next generation, it's obviously not my generation, what are the things that are important to them, because they're all building startups around those issues. So that's been really fun. And I mean, I say to everyone, if you have the opportunity to teach, it's been one of the most unexpected joys of my life. I absolutely just love it. And I love the community over at Cornell Tech. So it's been really fun.
That's amazing. But tell us more about your book, Venture Everywhere. Who should read it and why?
So my book, here, I'll give you my little plug for my book, just came out. And, my thesis is very non-consensus. It's really about investing in startups around the world. And I've been traveling and living around the world. I've traveled to 100 countries. I lived in multiple ones. I've just met some of the most extraordinary people building companies far from the globe, Silicon Valley, right? So far from that ecosystem, but they've seen problems in the world that they've wanted to solve. And without all the resources and without all the, the Silicon Valley glow, they've put their heads down and they've done it. So the book is 12 chapters, 12 countries, 12 entrepreneurs changing the world. Many of them have built, massive companies, unicorns. Some have been acquired. And really, I tried to get to the heart of what really drove them. And so, I have these interviews where I start, kind of as you did, about what their childhood was like. And the most interesting thing about the book was interviewing these founders. I cannot tell you how many of them got choked up as they were telling their stories. And these are people very successful. And I thought, oh my gosh, it's very raw, kind of going back to the beginning. I interview a founder who grew up in a small village in Pakistan. None of his family had gone to school, right? And, just to get from that to a company that's acquired for $3 billion by Uber, what is that journey and what are the learnings along the way? So I try to, dive into that and really expose what I call the everywhere mindset, which is kind of a set of principles and, ideologies that these founders have developed over time. So the book was just really fun. It's very personal to me. Every founder that I interview is also paired with a fun story of me in that ecosystem. So whether it's China or Brazil or Kenya, it's kind of my journeys there, what I've interacted with the startup community there, and then who are the builders on the ground.
Amazing. So if you could go back and give yourself one piece of advice at the start of your VC journey, what would it be?
You just need a lot of patience. Yeah, I always tell this story. I was 5 years in. I had to investing. Hadn't returned $1 of capital. And I call my mentor. One of my mentors said, I think I'm not good at this. I think I should maybe try something else. Mentor is a guy named Brad Feld. Many people know. And Brad said to me, you knew getting into this that at the earliest stage, it's a 10-year journey. And you've got to just put your head down. And he kind of read me the riot act. And I knew he was right. But in my heart, I just felt like I was used to having success, feedback, all those kinds of things in a much quicker timeline. And this was just like, felt like I was sitting around waiting, right? And I had no idea whether I was good. I was no idea. Anyway, it was funny. So that happened year 5. I talked to Brad 5.5. So 6 months later, one of my companies is acquired by DocuSign, and my whole fund gets returned by multiple times. And like all of a sudden that just turned around in 1 second. But it was like, what I would say to my younger self is like, it just takes a long time. Anyone deluding yourself that you're going to get feedback along the way, it just doesn't happen. It's very different than other professions.
I love that. Yeah, and I've heard that before. That years 4, 5, and 6 of your VC journey are like the loneliest years.
Rough.
Yeah, because businesses are going out of business left and right, and you're like, oh my God, am I bad at this? And your DPI is 0, and your TVPI is not looking good, and you're just like, oh my gosh, what is going on?
But then it can turn on a dime, right? And so year 5.5, it turned around. I got my confidence back, and yeah, I've never looked back. And so now, with my funds and everywhere, like I just don't sweat it, right? I'm like, all right, our 2020 vintage, like we'll see how that one goes, but it's going to be a long time, right? So yeah, I learned that lesson the hard way.
Love that. Well, let's wrap up with a quick rapid fire, if that works.
Sure.
First check you ever wrote?
First check I ever wrote was into a company that did crowdsourced video translation, and it was acquired by Rakuten for $400 million, like 2 years after I invested in it, and I was like, I got this.
I'm so good at this.
Little did I know. Oh my God, this would be so hard. But yeah, sometimes when you have that early success, it's a little bit of anyway.
Oh yeah, it could be a bad actually.
Yeah.
Most underrated founder market right now?
For a founder to build in, you mean?
Yeah.
I think consumer, right? Everyone so hates consumer, but honestly, like, I don't know what's going to be displaced by AI. A lot of B2B software companies, but consumers still want to buy things. So they still want interaction. So yeah, I don't do a ton of consumer, but I think it's underrated.
Love that. What about internationally? Which country is underrated right now to build a startup in?
I mean, LATAM, I think Brazil is just such a great ecosystem. I have a whole chapter in my book on it, and I'm just blown away. And I think more US investors need to make the trip down to Sao Paulo.
Yeah, I've never been. My wife's been twice, so it's definitely on our list. We need to go. What's a red flag you trust your gut on, even if others disagree?
The jerk quality. I just can't invest in them. I get the chip on the shoulder. I totally get, sometimes founders are a little salty. I think I can be that way. But if you're a real jerk, it's just not worth it. Like, life's too short to have to deal with people like that.
Yeah. Like if you're a jerk.
I have passed on founders who've had that and have gone on to build really big companies. And let me tell you, it stings. It really stings. But the aggravation of dealing with someone like that.
I've only passed on one that I can think of. It was some YC founder who just gave me a real just, he's just being a jerk. And I'm just like, hey man, I get it. You're great. What put that chip on your shoulder, right? Yeah. And he didn't have a good answer.
No.
And like I could usually disarm people like that because I have a pretty rough childhood and background, and I get it. I have a chip on my shoulder. And I'm very ambitious and all that stuff. Yeah. And so I can usually disarm that from people, but like I couldn't disarm him. And I was just like, it's just not worth it, man.
Not worth
it.
Just pass.
Which one, health tech or fintech?
Health tech. Especially having gone through a big trauma recently. I mean, there is so much work to be done. I cannot tell you. I live in New York City, part of some of the best hospital systems. And just what I have seen in the last few months is just shocking. It's just not a lot of coordination and so much improvement. So I'm very excited about it.
Love that. I have a good one for you. I'll tell you offline. Founder you would invest in again without hesitation. Out of 300, you probably have plenty, but what's one that comes to mind?
We talked about the Chainalysis one, so I'd say Johnny and Michael, no doubt.
I love that. What's a book that you gift the most besides your own?
My co-founder, Scott, he wrote a great book called The Fuzzy and the Techie. He wrote it in, I think, 2016 or 17, all about how we need both the balance of kind of STEM and liberal arts. And he kind of goes into some of those learnings and those characteristics. And, I think the book was smart back then, but like, wow, in the age of AI, is it like the most amazing book, right? As we're kind of swinging back and forth, as people are saying like, okay, now you don't become an engineer because that's going to be, completely displaced. It's like, so
that's wild.
Fuzzy and the Techie. It's a great book.
What's one thing you would change about the current VC model?
Oh my gosh. I mean, I think we talked about it. There's so many things.
Yeah.
I would say just the inequality of being able to, just so many founders, so few investors, and really figuring out. And I don't think it's through matching. I don't think it's through all these people that try to pitch us. I think there's going to be some big seismic thing that solves this.
Somebody will build the platform for that at some point.
Something
Angel has
like
tried to do it, 10 or 15 years ago, but it didn't quite work out. It still required GPs, I think. And yeah, maybe someday. There's other crowd and equity funding platforms, but they tend to be not as good at deals.
It's going to be something really big. So
Yeah.
I don't know what it is, but I feel it coming.
Some AI agentic, my agent talking to your agent kind of thing.
Exactly.
What's the craziest cold pitch that actually worked? You said you don't respond to cold inbound, but what's one that you're like, wow, that really worked?
I don't know, because I take so few cold pitches. I don't know. You tell me. I can't answer that one.
There's been a lot of creativity. I'll have founders pose as LPs, which is dishonest. And they'll be like, hey, I'm really interested in your fund. That'll get me on the call. I can usually flesh it out by looking at their LinkedIn. I'm like, I don't think you have money to invest. But it'll get me sometimes on a call and I'll be like, well, you just started the relationship off on the wrong foot here.
Like it.
Yeah. It's just icky. It's icky. What's another cold? I do respond to cold inbound, but I just send them to my form and I may or may not reply. And just know that if you're listening to this, I may or may not reply if you fill out that form. Try to get a warm intro. That's the best.
I mean, we had actually a funny one in our fund, very thoughtful email or message sent on LinkedIn to me and to my co-founder, which I did not know. I ignored it, as I unfortunately always do. My co-founder thought it was very thoughtful, interesting, took the call, fell in love with the founder. I met the founder, fell in love with her, and we basically led her pre-seed. So I love the idea of cold inbound. I just can't handle the volume of it. So that's a good example of something. But I loved her perseverance. She wrote the same email to both of us and got a very different response. So.
Yeah. I mean, you got to keep trying. If the cold approach doesn't work, you got to try other approaches. How do you do that with fundraising for you? If you're going out and trying to raise money from LPs and family offices and stuff like that, they don't respond to cold inbound either. You basically have to get warm intros.
On any of that. It's all through our network.
Oh, nice.
Yeah. Haven't done cold. So
yeah.
I think that'd probably be tough, but I don't know. Maybe
it is. What's the biggest misconception founders have about VCs?
I think that we spend all of our time investing. I mean, we're running a business like you are. So I am doing podcasts and marketing for us. I'm raising capital. I'm supporting a very large portfolio. I'm managing a team. So I invest, but I only invest 20% of my time. And so I think that's a real shocker when I tell founders that, 80% of my time is doing all these other things. And I think that's
Well, this was amazing. Thanks for coming on. I really enjoyed the conversation. Where can folks find you and your book online?
Yeah, so jennyfielding.com, Fielding at LinkedIn. Obviously, you can find the book at Amazon or Barnes & Noble. Actually, fun, I walked into the Barnes & Noble in my neighborhood and it was featured in the lobby and totally random. And I was like, oh my God, this is so great. So
oh, wow. Amazing.
That was a small little thrill for me because that's that Barnes & Noble on the Upper West Side is where I grew up. I mean, I used to go there every day after school and I just walked in there and there it was. Of course, then I told my mom and dad they had to go look. I was like, go look at my book.
That's inspiration to finish my book. I'm half done.
Yes.
And I just stop. Yeah,
you got this, Brian.
All right.
Call me
thank
for
you so
support.
much for coming on.
Thanks for having me.